Well, it's been quite remarkable, Karen. You're right. NVIDIA, the Magnificent Seven, we've seen some bifurcation within those big names. You'll remember in the movie, of course, only 3 of the Magnificent Seven are alive still at the end. So maybe a cautionary tale for investors within that. But the profits delivery has been quite remarkable. So what happens next? Where does it leave us? Well, as we look forward for the rest of the year, it's quite interesting that the sequential growth that is being expected to be delivered for the US stock market, other parts of global equities around the world, it begins to broaden out a bit more. It's no longer just about technology as we look to the second half of the year. The other 493 constituents of the S&P 500 are also doing okay and are expected to continue to support profits growth going forward. So I think the future trend is going to be one of a broadening out of growth for the rest of the market. What that does to index points is an interesting question because so much of the index weights is now concentrated in those tech names, those quality growth names that have performed so well. But when I talk to investors around the world, the big thing that they have on the top of their mind is, are these profits sustainable and what happens to the multiple? So there's a little bit of double jeopardy around those two elements because after such strong surprises, so many beats, elevated expectations and the hurdle for surprise being raised and raised, I think it gets harder and harder for these names to continue to beat those expectations. So the real good news here is that the broadening out trends do seem to be in play and the rest of the market also can be delivering profits as we go through the rest of 2024.
I'm going to pick up on your first point about which Magnificent Seven stocks survive, and this was something I spoke to John Chambers about last week, the former CEO of Cisco, that it's very unusual for companies in one cycle to really be the performers in the next cycle. So to transition from the cloud cycle to AI this time round, who survives? And it could just be a couple of the names, not all of them, for instance. But what we're seeing this time round that's different is that there's a geopolitical element where already we're talking about sovereign AI, building out capabilities in individual countries, because there are concerns about some of this technology just coming out of, say, the United States or coming from some sort of offshore area. That means, as to your story around breadth, there's a different tone to the breadth story. Companies do get to play in the economic growth story, don't they, at some stage, because sovereign AI makes things a little bit different this time around.
I think you're right, Karen. I've been calling this economic statecraft because it is, not sure that's the best phrase, but that's the best one that I've come up with. But what it's supposed to reflect is the fact that this is a profoundly different economic political situation than what we've experienced in the recent past. It's the most complicated economic environment of my lifetime, let alone my career looking at this stuff. Because you have a situation where protectionism, barriers are going up, that rolling profile of hyper-globalization is stalling out and being checked somewhat by different strategies, different industrial policies. Governments becoming more activist in how they are developing their national champions. So what does that do to the tech space and also the rest of the economy? Does it mean that you end up with some more regionalization? You end up with regional champions in different jurisdictions? I think that's quite possible. It's hard to know, hard to be sure, but what it does mean for investors is that there are gateways for companies to sustain market power, to continue to deliver profits, to take advantage of maybe strong positions of market strength and power within their individual regions. And what it might mean even more broadly is we begin to see greater opportunities within stock market investing for investors to look across countries at different parts of the world that are growing at different paces, growing with different political strategies, seeing different national champions succeed at different points in time. That's quite interesting and even profound for many investors because it means that the level of correlation within stock markets changes lower. We're used to thinking about all global equity markets rise and fall. Emerging market equities are a levered play on the global liquidity cycle, a levered play on the Fed. They're just high-octane growth stocks. But actually the new environment that we're going into with a situation where maybe geopolitics is more important, globalization is stalling out, economic statecraft is becoming a more important dimension of policy, that can quite importantly change how different equity markets, different countries are correlating with each other. There's no reason why Colombia and Korea should correlate other than it's a nice alliteration.
Yeah.